Well, mortgage modifications. Last week we talked about the extraordinary rate with which modification of troubled mortgages are redefaulting. Over 50% redefault after just 6 months of going through the modification. So what is actually involved with a loan modification? How does it work? How does it not work? And does it encourage folks to default? Our next guest says she is giving loan modification a try to help lower her payments. Madeline Lockhart joins us now by phone from Riverside, California. Madeline, are you there?
Yes, I am.
Hi, thank you so much for joining us. Tell us first of all about your house. When did you buy it? How much did it cost?
I bought it in October of 2006. It cost me $1.1 million.
And how much do you think it's worth now, if you could sell it?
I know it's only worth about $550,000.
$550. Okay, so about half as much as what you bought it for. Now, what kind of a loan did you get? Did you have to put money down?
Yes, I put 3% down.
3%.
Mm-hmm.
I'm smiling because I bought 3 properties in my life. I don't think I've ever had to put less than 10%. Did it surprise you at all that you didn't have to put much down?
No, it didn't. In all honesty, it didn't.
Okay. And tell us now how much your payments have gone up. I imagine your loan readjusted. That is, you're paying a much higher interest now than you were when you first got the loan, correct?
Correct.
What was the jump like?
Oh my God. My payments before were already $7,000, and they jumped to $13,000.
Hold on a second. $13,000 a month?
Yes.
$13,000. How much money do you make?
Not as much as I used to. I'm also in the mortgage industry, so that was a big hit for me.
But $13,000 in payment for one house every month?
Yes.
Wow. What percent does that represent as an interest rate?
It jumped to 9% from 6%.
All right. So who did you contact for a modification? How are you going through this procedure?
I the Bank of America, and I'm still going through the process now with the person also that was recommended to me.
All right. Bank of America is the bank that you were working the modification through. Is that the original bank from whom you got the mortgage?
No, it was First Franklin.
First Franklin. So First Franklin apparently sold it to somebody, maybe Countrywide or whatever, and eventually Bank of America picked up the mortgage, and they're the people that are holding the mortgage now, correct?
No, I'm going through Bank of America now. First Franklin is the one that's still holding the mortgage.
I see. They still hold it. Now, is the government involved in this at all, Madeline? Are they helping in any way that you know of?
Well, they're going to be assisting me through Bank of America.
Okay. So, and were you, I mean, I feel foolish asking because I couldn't afford $13,000 a month for a mortgage payment, but I'm just wondering, were you sort of encouraged to get behind on your payment, knowing that the government might be willing to help?
No, mine was medical reasons.
Okay. But again, $13,000 a month, I just can't imagine having to pay that much. Now, what do you think is going to happen? How much could you afford to pay?
I'm hoping it goes down to the current value. I hope the modification goes down to the current value.
All right, so you're trying to get the mortgage itself, the principal, reassessed down to the $550,000 mark. Correct. Okay, but you got to bring the interest rate down too, because not even at half of the value of the house, at 9% interest, that's a big chunk every month.
Correct.
So you want both the mortgage rate and the principal brought down.
Correct.
Okay. All right, Madeline, stay with us. We want to bring in some experts who might be able to give you a little advice here and there. Mortgage modifications, are they good news for the mortgage meltdown? Let's ask real estate analyst Danny Babb and Peter Zalewski of Condo Vultures, recently star of 60 Minutes. He joins us from Miami. That was a nice gig, Peter. I got to congratulate you. How familiar are you with Madeline's story?
We're seeing it every day down here. I know of one gentleman in particular. His loan was going bad, and Bank of America or Countrywide, whoever you want to call it, they approached him and they said, give us 25 cents on the dollar going forward for the next 5 years as part of a loan modification.
Well, so Danny,
on the monthly payment.
I would assume that Madeline is not going to have any trouble then, bringing the principal down and the interest rates.
That's not necessarily the case because she's in a jumbo market. Her existing loan is a jumbo. Chances are Bank of America and Bank Franklin are actually working in conjunction with one another to do a modification on Franklin's part into a refinance at Bank of America. And doing that with a jumbo is much more difficult than it is with a traditional.
Madeline, this is a jumbo loan, correct? I think anything
Correct.
by definition is it's got to be a jumbo loan. But when you got into a jumbo loan, did you have any idea that your monthly payments would jump to $13,000 a month?
Nope.
Did you read the fine print?
Yes, I read the fine print, but I also thought that I would be able to turn around and change my loan before anything happened. But because of the market, that wasn't, it wasn't valid.
Yeah, but Peter, did a lot of people get into these jumbos thinking that they'd be able to change the conditions on their mortgage?
I don't want to speak on behalf of Madeline, but I would say she probably got involved there because she was looking to make some money. She probably never thought that she would be still in the property by the time it came due, and now she's sort of caught in a catch-22.
Well, let's ask Madeline. Is that what happened, Madeline? Did you want to flip this house?
No, not this one. Sorry, this is
Oh, wait a minute.
one.
Hold on, Madeline. Hold on. You say not this one, but there were others?
Yeah, I have another one. Same issue.
Okay, but that's one that you did want to flip.
No.
Well, now, wait a minute. You wanted to hold two mortgages, at least one of which would cost $13,000 a month?
No, the other one is actually, it went from $2,000 to $5,000 a month.
2005. But the point is you were going to hold on to two houses.
I was going to temporarily. I was going to sell the other one in 2 years. It's just now in the process now.
All right. Well,
of it
Danny,
going there.
the point is here, Danny, is that she obviously was hoping to make money in real estate, as a lot of people were.
Sure.
But to hold two mortgages simultaneously, I mean, it's just by definition to me, it sounds nuts.
Well, a lot of people, I mean, I've done it myself with, a lot more than two, so I guess that would be on the extreme on the
So I'm just
scale.
not familiar with real estate. I'd be scared stiff to hold two mortgages like that.
There is money to be made if you can cover your cash flow. I mean, that's really the biggest problem that we're seeing. And she actually happens to live in one of the worst counties in California for depreciation.
Which county is that?
Riverside County.
Riverside.
Yeah, Riverside and San Bernardino County are off about 60% in 3 years. So
Well,
she got pummeled there.